So in less than a week, Silicon Valley Bank collapsed and Signature Bank, and of course everybody is concerned that this is part of a trend that will really tank the U.S. economy. Then today, shares in Credit Suisse hit an all-time low. The bank has been struggling for a while now, for several years. Last year, Credit Suisse reported an annual net loss of $8 billion, the largest since 2008. Late today, the Swiss National Bank said it will support Credit Suisse. So that's good, apparently, maybe, but the overall picture is scary. So how did this happen? What exactly are we watching? We thought it'd be nice to be joined by someone who's been in this world for a long time. David Sachs is the co-founder and partner of Craft Ventures, also the co-founder of PayPal and host of the All In podcast. He joins us tonight. David, thank you so much for coming on. I'm just going to stand back and let you explain what you think is causing this.
Well, Tucker, I think what's going on here, there's a bunch of issues that were particular to Credit Suisse. They've had a series of scandals and compliance issues and exec changes over the past few years. But there is a common pattern here with what's happening in the U.S. banking system, which is these banks are under tremendous stress right now. And if there's weaknesses at these banks, they're getting flushed out and exposed, and deposits are leaving the system very quickly, causing these banks to be imperiled, and then potentially creating the risk of the next cascading failure, because all these banks are sort of interlinked, and this is where you get sort of systemic risk. So what is causing this stress? I would posit that the reason for the stress is that we've had this rate tightening cycle for the last year. It's the fastest time that interest rates have been hiked by the Fed in our entire lifetimes. And what caused that? It was the worst inflation in 40 years. So this is basically what is putting tremendous stress on the whole banking system, is that rates have gone up so violently and so suddenly that deposits are leaving because they're going to other alternatives like money market funds, but also assets on the books that were supposed to be safe, like long-dated bonds, T-bills, mortgage bonds. All of a sudden, they've become toxic assets. They were supposed to be safe assets. Now they're basically toxic. And I think that everybody's trying to understand how deep this problem goes. And it's good in a sense that, you know, whether it's the Swiss government or the Fed is kind of taking steps to intervene and prevent a total run on the banks. I think that's good. But the problem is we've had such bad Fed policy for the last number of years now that it's entirely too little too late. And that's what makes the situation really scary.
So I think you described it well. Back to inflation. We had scary inflation just about a year ago. What caused that inflation? Let's go even farther back, if you don't mind.
Yeah, I mean, it's really simple. What caused inflation is money printing and excessive spending. We had trillions and trillions of dollars being spent and printed out of Washington. And this started even before the Biden administration. Biden really took it to a new level. Remember, in the first quarter of his presidency, we had that American Rescue Plan, which is $2 trillion of COVID relief that we didn't need because COVID was winding down. And the economy had already recovered and was hot. And that's why even Larry Summers warned him at the time. Economists of their own party said, listen, this risks inflation. And sure enough, the inflation came just 4 months later. And what did they do? They said it was transitory. It was a big lie. Yellen and Powell and Biden all said that this is transitory, so they could keep spending more money. And the Fed kept printing, and QE continued for another 6 months. I would posit that 6 months really created the bubble of 2021. The markets got super frothy. That's when tons of sort of hot deposits went into SVB and other banks. And it took the risk to another level. I mean, in other words, these guys ran the economy at 150 miles an hour, and then they slammed on the brakes. And what you're seeing now is the resulting car crash. And the only thing we don't know is whether this is a 2-car crash or a 20-car pilot summer, or that summer of 2021. When we first got that inflation print of 5.1%, if they had said, okay, we have a problem, this is not transitory, it's real. If they had started raising rates then, they could have done it more gradually. We would have had a lot more time, and we wouldn't have needed such a violent cycle of interest rate hikes that have now basically caused this enormous stress on the banking system.
So nicely put. Thank you for bringing it back to that, because all of this feels like the product of distortion of our economy by Washington. And it sounds like it was. David Sachs, appreciate you coming on.
Thanks, Tucker.